Every single day, trillions of dollars change hands based on one specific, totally invisible number.
Yeah, literally trillions.
Right. You look at a stock ticker on your phone, you see a price, and there's this, comforting assumption that somewhere a perfectly calibrated machine just spat out the exact mathematically correct valuation.
I mean, we'd like to think so.
Exactly. But behind that number is a foundational metric that essentially runs the entire global economy. It's called the cost of equity. And here is the staggering part. For a quarter of a century, the smartest people in the financial world have essentially been calculating it completely wrong.
Completely wrong.
So today, our mission is to unpack this metric. We're doing a deep dive into a dense, cutting-edge financial paper from March 2026. It's titled Investment-Based Costs of Equity by researchers Yiqing Liu from Ohio State, Chen Xu from the University of Cincinnati, and Lu Zheng from Ohio State.
Right, and it's a massive shift in how we think about this.
We're going to discover exactly why the traditional ways of measuring the cost of equity are failing us, and how a radical new model is stepping into the ring to fix it.
To really grasp the sheer scale of the money involved here, I want you to picture something in your mind's eye. Imagine standing in the center of a bustling financial district, looking up, and instead of clouds, the sky is just filled with glowing stock tickers.
It's just constantly moving.
Constantly moving. And every single one of those numbers, every major corporate buyout, every capital budgeting decision a global company makes, it all relies heavily on estimating this one specific metric. If the metric is broken, the whole sky is out of alignment.
Okay, let's unpack this, because before we dive into the heavy math and the new challengers, we really need to ground this. For someone listening who, might not work on Wall Street, what actually is the cost of equity in plain English?
Simply put, the cost of equity is the expected return an investor demands for taking on the risk of owning a company's stock.
So it's a baseline.
Yeah, think of it as the ultimate hurdle rate for capitalism. Like if a company wants to use your money to fund a new robotics factory or develop a revolutionary piece of software, they have to prove to the market that they can generate a return that clears that specific hurdle.
Right, or else why would you give them your money?
Exactly. If they can't clear it, the investment simply isn't worth the risk. But the paper points out this open secret in finance, which is that academia and industry have historically been terrible at measuring that hurdle accurately.
Which is terrifying when you consider how much global wealth relies on it. I mean, to understand this new solution the researchers are proposing, we first have to understand why the old tools are failing. The paper talks about the flawed status quo, specifically pointing fingers at two traditional heavyweights.
That's right. So the first heavyweight is the category of factor models. The most famous of these is the Fama-French model, which has been, a staple in finance classes for decades. Now, factor models look at broad market sensitivities. They measure how a particular stock moves relative to the overall market or relative to broad categories like small-cap stocks. But the authors of this paper highlight a remarkable admission. They actually quote Fama and French themselves admitting that the costs of equity produced by their own models are, and this is a quote, distressingly imprecise.
Wow. Distressingly imprecise.
Yeah, even when you look at very broad industry levels, they're just too noisy to be reliable.
And then there's the second heavyweight, which seems to get even more focus in the paper, which is the accounting-based implied cost of equity, or IC.
Precisely. IC has been a cornerstone of the academic literature for over 25 years. It's derived from dividend discount models. It looks at present value, expected earnings, and book equity, and essentially tries to back out the cost of equity using something called clean surplus accounting rules.
Wait, let me stop you there. Clean surplus accounting rules, what does that actually mean in practice?
Great question. It's an accounting assumption. It essentially assumes that every dollar a company earns either goes directly out to shareholders as dividends, or it cleanly and perfectly boosts the book value of the company.
So no weird loopholes.
Exactly. It assumes there are no messy, real-world accounting tricks, no hidden write-offs, no complex stock buybacks obscuring the math. In a clean surplus world, the math is perfectly balanced.
But the paper reveals a fatal flaw with ICE. The staggering takeaway from the source is that ICE has a remarkably weak association with actual realized returns in the real world.
Yeah, it's totally disconnected.
Let me use an analogy here for you listening. Using ICE to predict stock performance is like trying to guess a race car's top speed by reading the dealership receipt. I mean, the receipt tells you what the engine should cost and what the manufacturer claims, but it tells you absolutely nothing about how the car actually handles when you put it on a wet track with, real wind resistance.
That's a great way to put it.
The data shows that the ICE factor premiums often have the exact opposite signs of realized premiums in the real world. So I have to push back here. If ICE is so profoundly disconnected from reality, how has it survived for a quarter of a century as the gold standard in the academic literature?
This raises an important point, and the answer comes down to the difference between a controlled environment and the wild, unpredictable real economy. ICE makes perfect, beautiful, logical sense inside that strict accounting framework we just talked about.
The clean surplus world.
Right. If earnings and dividends behave exactly as forecasted by analysts, the math is flawless. But the real economy is messy. Analysts are constantly wrong. When researchers looked at the actual realized holding period returns, meaning the actual cash investors made, ICE was consistently pointing in the wrong direction.
Give me an example of that.
Well, for expected growth factors, ICE predicted negative premiums when the actual realized returns were highly positive.
So it's telling you to go left when you really need to go right. So if the old receipt method is broken, what does the new method look like? This brings us to the core innovation of this March 2026 paper. The researchers introduce a new challenger to replace ICE.
Yes, they introduced what they call the Q5 characteristics model, which we will just refer to as QCE. This is the absolute hero of our deep dive today.
Let's break down how QCE actually works, but I want to avoid getting bogged down in the quantitative jargon. The paper says it relies on Llewellyn's out-of-sample forecasts from cross-sectional regressions. That is a massive mouthful.
It really is.
Translate that into plain English for us. How does it calculate this number differently?
Let's break that phrase down because the mechanics are actually brilliant. Cross-sectional just means comparing a huge group of stocks against each other at one specific moment in time.
Okay, that makes sense.
Regression is looking at historical data to find patterns. And out-of-sample forecast means taking the patterns you learned from the past and applying them to brand new data to predict the future.
So instead of relying purely on accounting forecasts like ICE does, QCE looks backward to look forward.
Exactly. It takes a 120-month rolling window of historical data. That's 10 full years of hard, undeniable evidence of how stocks actually behaved. Then, it combines that historical baseline with 4 very specific, up-to-date characteristics of a firm.
What exactly is it looking at when it evaluates a firm?
It zeroes in on 4 things: size, investment to assets, return on equity, which is known as ROE, and expected growth.
Let's walk through why those specific 4 matter economically. I mean, why would those 4 traits determine a company's cost of equity?
Because they directly capture the risk and operational reality of the business. Take size. A tiny 50-person company generally carries far more operational risk than a mega corporation like Apple. Because of that risk, investors naturally demand a higher expected return.
Okay, what about investment to assets?
That looks at how much a company is currently spending to grow its asset base. Economically, companies that are heavily investing usually have lower expected returns because they are seen as safer, more established bets plowing money into proven operations.
Got it. And ROE?
ROE measures current profitability, how well the company is generating profit from the money shareholders have already put in. And expected growth looks at the runway ahead. QCE dynamically combines these 4 traits: how big they are, how much they spend, how profitable they are, and how much they will grow to forecast the cost of equity.
Think of this as the algorithm that helps decide if that tech startup you're investing in is actually worth its price tag based on how it behaves compared to a decade of hard data, rather than just what their accountants say their future dividends might be.
What's fascinating here is how the data distributes itself when you look at individual firms. The paper notes that the firm-level distribution for QCE is weakly left-skewed. Meanwhile, the accounting-based ICE model is heavily right-skewed.
Let's translate that for the listener, especially if you're thinking about how this impacts the risk in your own retirement portfolio. What does a right-skewed versus left-skewed distribution actually mean in this context?
Imagine you ask 100 people to guess the price of a normal suburban house. A left-skewed distribution means most people guess around, say, $500,000, but a few people guess unusually low. It stays relatively grounded.
Right.
A right-skewed distribution, which is what ICE produces, means most people guess $500,000, but a few people randomly guess $50 million. Those extreme, mathematically wild outliers pull the entire average up to an unrealistic level.
And the paper uses the term excess kurtosis to describe this, right?
Yes, kurtosis is a statistical measure of the fatness of the tails, which is just a fancy way of saying the likelihood of insane extreme outliers.
Yeah.
For a regular normal bell curve, excess kurtosis is 0.
Okay.
For the pooled ICE data, the excess kurtosis is an astonishing 28.46. For QCE, it's just 2.99.
That is a massive difference.
It really is.
Yeah.
What this tells us mechanically is that QCE provides a much more stable, realistic picture of a firm's true cost of capital without those massive, unrealistic spikes on the high end that make ICE so erratic.
But a new model is just a theory on a chalkboard until it's tested. So how does QCE actually perform against ICE in the wild? The paper details this incredible data smackdown using what they call portfolio sorts.
Sorting is the absolute cleanest way to test a financial model. You take all the stocks in the market and you rank them into 10 buckets, or deciles, based on what the model predicts their return will be, from highest to lowest.
Right, so picking the winners and losers.
Exactly. If the model is actually good at its job, the stocks it puts in the high bucket should genuinely earn significantly more in the real world than the stocks it puts in the low bucket.
So when they actually ran the simulation, what happened?
The results were definitive. When sorting stocks by the new QCE measure, the high minus low decile earns a substantial 1.62% per month at the 1-month horizon. It cleanly and effectively separates the winners from the losers.
And ICE.
When you do the exact same test for ICE, the high minus low bucket earns a dismal negative 0.03%. The old model essentially predicted nothing. It completely failed to differentiate which stocks would actually perform better in the short term.
The researchers also ran a cross-sectional predictive regression test, which tests for bias. If I understand this correctly, in a perfect world, an unbiased predictor would have a slope of exactly 1, meaning a perfect 1-to-1 ratio. If the model predicts a 10% return, the stock actually delivers a 10% return.
Exactly. You want that slope to be as close to 1 as possible. At the 1-month horizon, QCE hits a slope of 0.82. It is incredibly close to that perfect 1. ICE, on the other hand, is way off at 0.42. It is deeply, fundamentally biased.
So synthesizing those numbers, what is the practical takeaway for a portfolio manager?
It proves that QCE is vastly superior at predicting cross-sectional returns. In finance, the cross-section is all about direct comparison. If you are a portfolio manager looking at 1,000 different stocks on a Tuesday morning, and you need to rank them to decide which ones to buy and which to ignore, QCE is highly accurate at comparing those different stocks against each other at that specific moment in time.
And ICE just can't do that.
ICE fails at that entirely.
Now, with all this talk of optimizing data and running historical regressions, the obvious modern question arises. I mean, the paper is published in 2026. Why not just hand this enormous data set over to artificial intelligence? If I'm a quant at a hedge fund right now, I'm throwing deep learning at this problem. I want the AI to find the invisible patterns.
It is a totally valid question, and the researchers dedicated a fascinating section of the paper to exactly that experiment. They tested a machine learning method called gradient-boosted trees using a framework called LightGBM.
Okay, gradient-boosted trees.
Right. They wanted to see if allowing an AI to find hidden, nonlinear relationships between those 4 characteristics we discussed would beat their straightforward linear regression QCE model.
Before we get to the results, briefly explain what a gradient-boosted tree actually is. How is it different from standard linear regression?
A standard linear regression draws a straight line through data to find a trend. It says, as FIs goes up, expected return goes down. It's simple and proportional. A decision tree, however, splits data into branches.
Like a flowchart.
Exactly. It might say, if the company's investment to assets is above 10%, go left. Then, if its ROE is below 5%, go right. It creates highly specific, complex categories. Gradient boosting is a technique where you build many shallow decision trees sequentially, with each new tree trying specifically to correct the errors of the previous one.
So did the AI beat the traditional model? I mean, why did the authors ultimately opt for time-honored cross-sectional regressions over advanced machine learning?
It comes down to a fundamental trade-off involving something called overfitting. The paper points out that highly complex decision trees are incredibly prone to overfitting. They essentially memorize the historical data perfectly, capturing every bit of random noise, but they fail to generalize when they encounter new, unseen data in the future.
Oh, I get it. It's like a student who memorizes the exact answers to a specific practice test, but then fails the actual exam because the questions are phrased slightly differently. They learn the specific answers, not the underlying concepts.
That is the perfect analogy. Now, to be fair, the gradient boosting did work to a certain degree. The machine learning model slightly improved the one-month return spread to 1.79%, up from QCE's 1.62%.
Okay, so a small bump.
But there was a significant catch. While it performs slightly better at that specific one-month mark, it actually worsened performance in other critical evaluation metrics, particularly in measurement error variances.
You mentioned measurement error variance. What does that actually look like for a fund manager trying to use the model?
It means the AI's predictions were jumping all over the place. The noise level increased, the researchers had to make a choice, and their verdict was clear. They chose interpretability over a very marginal gain in forecastability.
They didn't want a black box.
Exactly. When you are managing billions of dollars or advising on the valuation of a corporate merger, you need to understand why the model is making a prediction. The linear QCE model is grounded in solid economic theory. You can see exactly how a firm's current profitability or expected growth is mechanically driving its cost of equity.
Unlike the AI.
Right, the machine learning model, while powerful, obscures those economic mechanisms behind layers of complex code.
That makes total sense. So having settled on the linear interpretable QCE model, let's look at how it evaluates the actual physical economy you and I interact with every day, because the paper digs deep into specific industries.
Remember earlier when we noted that Fama French factor models were distressingly imprecise at the industry level? QCE essentially solves this problem. The researchers evaluated 57 non-financial industries. When looking at actual realized returns, the volatility across these industries is profound, almost 26% per annum.
Wow, 26%.
And Fama French models only brought that volatility down to about 10%, leaving a lot of unexplained noise.
But the 12-month QCE brings the volatility down to an incredibly tight 4.4%. I mean, it is remarkably precise. It gives us a stable, clear picture of how different sectors fundamentally operate.
And this allows us to see how the market prices risk in the real world. For example, the paper found that information and data processing services have one of the lowest costs of equity, hovering around 7.1%.
Which makes intuitive sense when you think about the mechanics of that industry. Software and data processing often have high margins, recurring subscription revenue, and relatively low physical capital requirements. They don't need to build massive new factories to scale. Because of that, they're seen as fundamentally less risky by investors.
On the other extreme, real estate has one of the highest costs of equity, at 15.47%.
Again, mechanically, that tracks perfectly. Real estate requires immense upfront capital, it is highly sensitive to interest rate fluctuations, and it is generally a riskier place to park your money if the macroeconomy turns sour. Investors demand a much higher expected return to lock their money into a physical building. QCE captures this economic reality beautifully.
It really does.
But there is a bizarre finding in the sources that we absolutely have to discuss. The researchers tested what happens when you remove microcaps from the data. Microcaps are the absolute smallest publicly traded companies. And the stats here are wild. Microcaps make up roughly 60% of all the individual stocks on the market.
But despite making up 60% of the sheer number of companies, they only account for about 3.5% of the total market equity. They are incredibly plentiful, but financially tiny.
Right. So logically, you would think removing them wouldn't matter much to the overall math of the market. But the paper found that excluding these tiny companies drastically altered the long horizon forecasts of the model. When predicting returns 60 months out, excluding that tiny 3.5% of market equity made the model's accuracy completely plummet. Why does ignoring tiny companies break a 5-year forecast?
What's fascinating here is how the passage of time changes the nature of risk.
Yeah.
Over a short 1-month horizon, a microcap is just going to stay a microcap. But over a 60-month horizon, 5 full years, microcaps can experience explosive, exponential growth and turn into major large-cap companies.
Oh, wow.
Conversely, a large, stable company can suffer catastrophic losses, go bankrupt, and shrink into a microcap.
It's the circle of corporate life?
Exactly. Microcaps represent the absolute extremes of risk and reward in the market. By excluding them from your data set, you are essentially truncating the right tail of the expected return distribution. You are willfully ignoring the most volatile dynamic part of the market.
So you're losing the extremes.
Right. Over a 5-year period, those extreme movements contain critical information about how risk is priced globally.
Hmm.
QCE thrives because it learns from the entire spectrum, including those extremes.
Up to this point, QCE looks like the undisputed champion. It destroys ICE in the cross-section, it is precise across industries, it learns from microcaps without overfitting, and it avoids the black box trap of AI. But the paper contains a major plot twist regarding the old, supposedly broken ICE model. Here is where the research takes a completely unexpected turn.
Yeah, we established very clearly that ICE is terrible at comparing stock A to stock B, but when the researchers shifted their focus and ran time series predictive regressions for the aggregate equity premium, the results completely flipped.
Let's define that term. The aggregate equity premium is basically the expected return of the entire stock market as a whole over the risk-free rate, right?
Correct. We're no longer comparing individual stocks against each other. We're zooming all the way out and trying to predict the broad, long-term movement of the entire market. And in this specific arena, ICE is suddenly remarkable.
Wait, really?
Yes. When forecasting 60 months out, ICE hits an R-squared, which is a statistical measure of predictive power, meaning how much of the market's movement can be explained by the model of up to 24.5%. That is a phenomenal level of predictive power in financial forecasting.
Wait, hold on. How can a model that gets the cross-section so completely wrong, a model that literally gives the opposite sign for factor premiums and acts like a broken thermometer, be so brilliant at predicting the long-term aggregate time series of the entire market? Meanwhile, QCE, our hero for the past 15 minutes, performs weakly here. Its predictive power for the aggregate market is sometimes even negative out of sample. How is that functionally possible?
It comes down to the underlying mechanics of what the two models are actually built from. ICE is derived from broad accounting valuation ratios, book equity, expected aggregate dividends. Historically, these broad accounting aggregates have been excellent at anchoring the overall market to reality over long periods.
Because they look at the big picture.
Right. It effectively captures the slow, mean-reverting trends of the macroeconomy. Even if analysts are wrong about individual companies, in the aggregate, those accounting numbers tie the total market to underlying economic fundamentals.
So it's looking at the size of the total pie rather than worrying about how the pie is individually sliced.
Precisely. QCE, on the other hand, is built on the Q5 characteristics. It is rooted in an economic theory designed specifically to compare the operational efficiency of one firm against another at a specific moment in time. It is deeply microeconomic.
Okay, I think I'm getting it.
To use an analogy, QCE is a highly calibrated sniper rifle, excellent for picking out specific targets. ICE is a massive radar dish, terrible for targeting, but excellent at telling you the general direction a storm is moving.
So QCE wins the cross-section, ICE wins the time series.
If we connect this to the bigger picture, the authors introduce a concept they call scientific pluralism. It is the philosophical idea that for deeply complex real-world systems like the global economy, there is no single universal theory of everything.
We can't just rely on one equation.
Exactly. We cannot just throw ICE in the garbage because it fails at cross-sections. Good science requires integrating diverse, imperfect models. We need QCE to pick individual stocks and evaluate specific industry risk, and we need ICE to understand where the overall market is heading over the next 5 years. They are not contradictory, they are complementary.
So, synthesizing this entire deep dive, the cost of equity is the invisible engine of the financial world, and measuring it accurately has plagued the industry for decades. The new QCE model is a profound leap forward. By using a decade of historical regression on specific firm characteristics like size and profitability, it allows us to compare stocks and industries with unprecedented precision, avoiding the dangerous outliers of older models and the black box nature of modern AI.
Beautifully summarized.
But, in a great plot twist, the old, flawed ICE accounting model still holds the crown for long-term aggregate market forecasting. We ultimately need both tools in the toolkit. And whether you are investing your 401k in a basic index fund, picking individual stocks on a trading app, or just trying to understand how massive corporate buyouts are priced, these mathematical models are the silent forces shaping your financial reality.
I want to leave you with a thought on the very nature of what these models are trying to measure. The authors conclude the paper by citing philosophers Deleuze and Whitehead.
Oh, getting philosophical.
They argue that the economy is not a simple mechanical machine that eventually settles into a perfectly predictable state of equilibrium. Rather, it is a rhizomatic network. It is a complex, adaptive system. It is fundamentally a living, evolving process where constant change is the only permanent rule.
Which brings us to a final provocation for you to mull over. If the economy is fundamentally a living organism that refuses to stand still, adapting and mutating every single day, will any mathematical model ever truly capture the definitive cost of equity? Or are we simply destined to keep building better, sharper, but ultimately temporary maps of territory that is constantly shifting beneath our feet?